Okay, so yeah, like I said, this is just a session just to discuss potential changes in the market, opportunities for investing, and any questions anyone has regarding the markets. Obviously, the recording will be posted for those who've missed it on the platform. Obviously, with the vaccine rollout across the world, most of the developed countries are speeding up the vaccination program in terms of Canada, America, UK, Europe. So millions are being vaccinated. So the hope is that with the huge numbers being vaccinated, the potential of herd immunity and reduced number of cases, as we know, the lockdown measures are beginning to be eased in most countries around the world. And, in some countries, you're looking at as early as April, where, they'll be allowing restaurants to open, concerts to take place. Obviously, the airline industry can't wait to start flying people around the place, but obviously they're looking at having measures in place. So obviously with all this happening and the global economy beginning to open up, obviously that could create opportunities for some industries that have been down in the dumps. So obviously like the tourism industry, the retail, the hospitality industry, the cinema industry, the airline industry itself. So all this could be potential opportunities to pick up cheap stocks or cheap, or make, I won't say killing, but if one times it right and buys right, you never know. Obviously, it doesn't take away from you doing your fundamental analysis and making objective decisions as to which company you think is solid enough to recover in those industries. For example, the one we were discussing in the, I think at the last question and answer session or before then, where we talked about IAG, the airline company, the possibility of of them recovering. So I think a couple of us on the group bought this stock. And like I said, with all these things going on with the vaccine, you can see the share price is beginning to recover. Let's actually look. Let's look at the 3-year time frame. So looking at the 3-year time frame, you can see that obviously there was a huge crash during the pandemic. It's just been hobbling along, but you can see it's gradually beginning to recover. Air France is another one. Let's look at Air France. And that's another one I've sort of been keeping my eye on, just because I use Air France a lot. So I just keep an eye on them. But yeah, it's just being aware that, there's some of these companies, there could be opportunities to be had. Of course, as usual, I am not making any specific recommendations. I'm not saying you should go and buy this or buy that. You need to do your fundamental analysis, do your homework, check out seriously the industries and the companies and decide whether you want to buy them or not. So you can see Air France is currently 5.27 euros per share. You can see it's quite low at the moment compared to when it was about 14 euro per share. So you can see it has a potential of about 150% return if it goes back up to where it was before. Obviously, you're not saying that's what's going to happen, Who knows? They can even go bankrupt. You never know. But like I said, with the economy opening up, with the huge rollout of the COVID-19 vaccines, industries that have been dead and buried, they could become revived, and the industry and the companies within the industry can then start picking up, and there could be a huge rebound in those companies and industries that could make potential for good returns. So yeah, it's just to keep an eye on that and to be aware of that, and something to consider if you're looking for opportunities in the market or looking for where you could pick potential stocks to invest in. Okay, so obviously, like I said, this is a question and answer session. It's not a formal session. I'm not going to be doing any presentation. So it's just an opportunity. If you have any questions or comments or opinions, anything you want to share, ask, discuss, this is just the opportunity to do it. So it's, like I said, the floor is open. And of course, if there are no comments or questions, it could be a very short session. So how short or how long the session will be, it's entirely up to you guys. What is market correction? Yeah, market correction is, actually, that's just a fancy term. Let me actually bring up the whiteboard. It's very funny when it comes to the financial markets. They like to use a lot of fancy terms when it comes to the financial markets. Now, when you look at the market, any market, it doesn't matter whether it's the stock market, commodities, currency, any market, markets never go up and down in a straight line. So that never happens. Markets don't go up and down in a straight line. So when markets go up, they will go up and then they'll fall back down, and then they'll go up again, and they'll fall back down, they'll go up again, they'll fall back down, they'll go up again, fall back down. So when the market, this is normal, this is a normal phenomenon in the markets, all markets. It's just a normal phenomenon. And those of you who trade know that this is what happens on a normal basis, on a daily basis. The market goes up and down like that. So this is a normal market trend. So it will go up, fall back down, go up, fall back down, go up, fall back down, go up. But it's still, going up anyway. Now, the terminology is that when it goes up like this, and then it falls back down, they call this a pullback. So it calls this a pullback. Or that is actually what some people call a market correction. So it goes up, it will pull back, which is the common term, but they also call it market correction. That it will correct, or market correction, and then it goes back up again. And then it will pull back again, or what they call a market correction, and it go up again, and it will pull back again. So it's just a normal market phenomenon. But of course, that's the danger with financial news and reports. They need to fill the airways, they need to fill their columns, they need to make the market exciting. So when they're reporting on the daily basis, they'll be throwing all these terms out, which really don't make any, they don't mean anything significant. It's just a normal phenomenon that happens in the market. So from a long-term investment point of view, it's not really a big deal. As a trader, yes, as a trader, that's what you're watching for on a daily basis as a trader. But as an investor, that's a normal phenomenon. I mean, the market will go up, pull back, go up, pull back. And then the opposite, when the market is falling, it will fall, then we'll go back up, then it will fall, it will go back up, fall, go back up, fall. So like I said, the market never goes up and down in a straight line. So it's still falling, but it's going up, it's going down and up. Now, when it does this, when it falls and then it goes back up, they call this a rally. So it rallies back up. So this is what we call a rally. So when it's going up, they call it a pullback. When it falls back and it goes up. When it's falling and it goes back up, they call it a rally. Then it will fall back down, then call that a rally. When it goes up, it will fall back down, then to rally back up, but it's still going down. So that's, like I said, a normal phenomenon. You say, why are the tech stocks down? Again, it's actually, that's a good question. And that just goes to show what I was just saying, is that no company, no industry, everything. I mean, you'll never find any company, even Amazon, Apple, Samsung, Zoom, whichever company you think about, you will never find the stock price just going up, just going up and up. You will never find that. That's all that will just be happening. They'll just be going up in a straight line and shooting up. That never happens. So it's just like I'll describe it, what you normally get is they'll go up and they'll fall back down. They'll go up or fall back down. And actually, to be more specific, that's what some people call profit taking. Because obviously sometimes if you buy, let's just put a figure on it. So let's say you buy a stock at $2. So maybe 1,000 of you buy the stock at $2 and then it goes up to $10. Then some of the people who bought it at $2 out of this 1,000, some of them might decide, oh, let me cash in. They sell and it falls back down a bit. So they call that profit taking. So some people just want to take their profit and go and enjoy themselves. And then when it drops, some of people start to buy it again and it goes back up. And then when it goes back up, some people will take off their profits. They'll sell some of their shares, take their profit. The price falls back down. And then when the price falls back down, people who are looking to buy it will think, okay, let me buy it on the cheap. And then it goes back up again. So most of these things that tend to happen in the markets is just normal market phenomenon. Obviously, there are specific things, obviously, as you all saw with the COVID crisis, that will cause the market to fall. If there's competition, so if there's a company that is beating the competition, like we see with Zoom and the competition, or you see with Netflix and blockbusters. I mean, Netflix caused blockbusters to more or less go out of business, so that's why the shares of blockbusters will fall. So sometimes competition can cause share value to fall, market forces. Other things can happen. So yes, it can be a combination of factors, but sometimes it could just be straightforward, people just taking their profit off the market. So there's not really one specific reason you can say, okay, this is what's causing. Obviously, you might have to look at each company on its own merit. So let's look at Apple, for example. Let's look at Apple. So this is Apple. So you can see Apple shares are falling. And actually, but before I go to, let me go to MarketWatch. Because again, this is where you need to ask yourself, are you trading or are you investing? Because even if Apple shares are falling, the question now you're asking yourself is that, do you want to buy Apple shares for the long term as an investor, or are you trading Apple shares? And again, this is actually why it's always crucial to always distinguish between trading and investing. Now, if you're an investor, you'll be looking at Apple and, in fact, you'll be thinking to yourself that this might be an opportunity to buy Apple cheap because the price is falling. And of course, again, as usual, you need to go back to your fundamental analysis. You need to go back to say, okay, is everything okay with Apple? Are they still competitive? Are they still profitable? You still need to, that's why I say you still need to do your homework and your fundamental analysis. You can see the current P ratio is 32, so it's still high. Again, you look at the financials, is it still a profitable company? So let's just quickly go to earnings per share. So you can see the earnings per share is gone from 2.09 to 2.32 to 3. So it's been going up. It dropped slightly. It's not too bad, from 3 to 2.99, and then went back to 3.31. So Apple is a profitable company. So it's a profitable company, so it's still solid in terms of its financials. Obviously, we know there's still high demand for Apple products. We know there's no change in their management structure. Forget the guy's name, the CEO of Apple. What's his name? I can't remember the guy's name now. What's the guy's name?
Tim Cook.
Yes, thank you. Thank you. Yeah, so Tim Cook is still there. He's still at the helm, you know, so there's nothing untoward regarding Apple as a company. Then, you know, let's also go to the news. So let's go to Apple. Oh, Apple company. Let's go to news. So you can see Intel, Apple Inc. shares gain contribute to Dow's nearly 350-point rally. So it shows that, you know, even Apple shares went up today. So again, it goes back to what I was saying about the market never goes up in a straight line. It will go up, it will come down, it will go up, it will come down. And in fact, that's what some investors are looking for. That's what they're actually looking for. They're looking for when the share price goes up, they're waiting for it to fall back down a bit. So they wait for this pullback or the so-called market correction. And then when they see it going back up again, then they buy. So some people use that as an opportunity to buy because, again, like I say, it's a normal market phenomenon. It's nothing unusual. So from a long-term investing point of view, you can see that you can see here, it's just 4 days ago, they say Apple stock outperforms the market despite losses on the day. So yeah, companies, industries, the shares will go up and down on a daily basis. You don't need to worry about that as an investor. As an investor, you will find ups and downs. I mean, if you look at, let's go back to the Apple share. So you can see even over the last, let's even go over the last 10 years. So you can see it doesn't go up in a straight line. It will up, down, up, down, up, down, up, down, up, down, up, down. But you can see it's always on the upward trajectory. So yes, but obviously the news commentators can make you think something cataclysmic is happening when they report on it on a daily basis. And they're shouting, oh, the market has fallen. Oh, the market has gone up. Oh, the market has fallen. That's just all noise from a long-term investing point of view. So as a long-term investor, again, you just stick to your fundamental analysis. You know, is it a solid company? Is there a demand for their products? Are their financials good? Are they profitable? Are they competitive? If all those answers are positive, then you're just looking to buy, depending on your strategy. If you're doing value investing, you're looking for low P ratios. If you're doing growth investing, well, you can still buy it at a P ratio of 32 if you're doing growth investing. And again, this is where the charts come in. You can say to yourself, okay, all the financials, all the fundamentals look good for this company. It looks like a solid company. So you just, okay, it's falling. When I see evidence of it going back up, I will buy it on the cheap on the way back up. But yes, the specific answer to your question is that market correction is just a normal phenomenon in a market trend. When it's going up, it will go up, it will pull back, which is the market correction. It will go up, it will pull back. When the market is falling, the same thing too happens. It will fall, then what we call a rally, and then it will fall, it will rally back up. And then, like I said, while the tech stocks are going down, yeah, like I said, it's a combination of market forces, profit taking, and all that. But from a long-term investment point of view, it's not a problem. Now, from a trading point of view, now if you're now trading Apple on a daily basis, and which is a whole different ball game, then yes, you might be looking at shorting Apple stock, selling it, going short, profiting from it falling, and then you come out of your position when it starts to go up and you go long when it's going to back up. But again, that's trading, which is a whole different ball game. But yes, that's again just to highlight again why it's important to differentiate between trading and investing, because once you're clear what you're doing, it makes it easier to determine what you need to do regarding what you're doing. So if you're investing in Apple stocks, you don't worry about all this market correction and all that. What your focus is on the fundamentals. Is it a fundamentally sound company? Is it competitive? Are they in demand? Are they profitable? Are the financials good? That's what you're looking at. And then you're looking to buy it on the cheap for the long term. If you're trading, then you're just looking to profit within a day. And as a trader, you can profit from the stock falling or going up. But again, as a trader, it's high risk. You need to have a strategy of when to enter, when to exit the market. Any other questions? The other one is, what's his name? Tesla. TSLA. Tesla is, that one too, it's just been a crazy company because, what's his name? Elon Musk is just a very loud, brash chap. But, the company itself is, I've never really liked Tesla because it's never been an extremely fundamentally sound company to me. That's just my own opinion. All the fundamentals have never been good. I've been watching Tesla for a long time, and I've never bought it because it's just all over the place. But obviously, Elon Musk is always in the news. He's always, blowing hot air regarding the company and exciting people, and it shoots up the price. But when I just look at it from an objective point of view, you can see number one, the P ratio is crazy, 1,000. That's the P ratio. They don't pay dividend, which again, something I like. I prefer buying stocks that pay dividend. Tesla doesn't. And then when you look at the financials, I haven't looked at it in a while, but before it wasn't very good, but let's look at it. So again, you can see the earnings per share has always been negative. So in the last 5 years, they've been losing money. You can see it's only this year that they've made a profit, or last year, 2020. So it's just 2020 that they've made a profit and had a positive earnings per share. The years leading up to that, you can see it's just been negative. So again, this is why I always say you just need to be clear and not emotional when it comes to investing. Number one is knowing the difference between trading and investing. And number two, even if you're trading, you shouldn't be emotional. And also when you're investing, you shouldn't be emotional. You shouldn't buy because it's a sexy stock or because everyone is talking about it and everyone is running about it. In fact, that's actually why a lot of people lose money in the stock market, because they just go with the crowd without being objective. They just go with what everybody's doing. Everybody is buying cryptocurrency, so people rush there. Oh, everybody is buying this, they rush there. They just rush it with the with the crowd without even stopping to think and make an objective decision. So like I said, I've been following Tesla for 2 years, but I never bought it because it's never been profitable. P ratio has always been high. The fundamentals has been terrible. And, I had no justifiable reason in my own book to ever buy it. So again, to someone like me, I'm not surprised that what they say, the house built on cards, it will soon fall. There's no solid foundation to this company from my own point of view. So for Tesla in particular, I'm not surprised that the share price is falling dramatically. So this is actually a good example to compare Tesla with Apple. So with Apple, it's a solid company. We've got solid products that everybody knows about, that everybody's in demand. I mean, there's some people that are just Apple. They will not buy anything other than Apple. Their laptop, their wristwatch, everything is Apple. They're always upgrading it. You know, Apple is diversifying into other products and other things they're doing. It's a valuable brand. It's well known. It's well liked. You know, everybody wants an Apple product. It's in high demand. They're profitable, as you can see from the earnings per share. So with Apple, you know, I'll be looking at, yes, this is a company I would like to buy. And when I see the price falling, I will actually be excited, thinking, okay, opportunity to get it on the cheap, compared to Tesla, whereby, you know, the opposite is the case, where everything is just completely wrong to me. So again, it goes back to always making sure your fundamentals and your basics are always solid. Because once you start things up from a fundamental and solid foundation, then that's when you tend to make good and objective decisions. And that's what's very important, that you don't make emotional decisions when it comes to trading, or even, I mean, you shouldn't make emotional decisions when it comes to investing. And also, obviously, that's the same thing too with trading. You know, there has to be an objective reason why you're buying any stock or any ETF or any index funds. What is your objective reason? It shouldn't be an emotional reason. Any questions? Any more questions? Like I said, this session is for you guys. So like I said, oh, Uzo.
Hi, good evening.
Hi, how are you doing?
I'm good, how are you?
I am well, thanks.
Good, hi everyone. So I have a question. I think it was a few days ago you'd put up an article about Amazon, and you'd mentioned that, I think it was Amazon, yes, and you said that it seemed that it was ripe for split stock.
Ah, okay, yes. Yeah, I remember.
You post too many stuff, that's why.
Yeah, it's when you mentioned the stock split, that's what I remembered.
Yeah, stock split. So I was wondering what would be the benefit of doing that for, I guess, an organization and an investor?
Okay, two things. Number one, I'll show you. I actually posted something on that on the platform, but I'll show you shortly. Now, usually when stocks are very expensive, you know, let me bring it up. Amazon, AMZN. So you can see now, to buy one share of Amazon is $3,000. Yeah. So are you happy to buy that share?
Well, I guess it depends, because I've been tracking Amazon for a while, and the share price has actually fallen from what it was before.
No, I know, but I'm just saying in general, are you happy to buy such an expensive share, $3,000 for one share?
Well, if I've done my fundamental analysis, I might think that.
No, okay. I just want you to give me a gut answer, not technical answer.
So my first instinct would be, had I not done the investment course, I'd say absolutely not.
No, okay. Okay, what I'm trying to get at is that it's too expensive.
Right, okay. Okay.
You know, just to buy one share for $3,000 is too expensive, isn't that right?
Yes.
Okay, so that's going to put off a lot of small retail investors. They can't afford to be buying a stock at $3,000 for one share. So because of that, you might find that it's only rich people that will buy this stock, you know, because one share. So because of that, you find that companies like that in itself makes them not desirable to stock shareholders or potential buyers. So what they would then do is to split it. So when they do a stock split, so for example, they say 2 for 1, That means they will just divide this by 2. So it will now become $1,500 per share. Or they might do 3 for 1, when it's now drops to $1,000 per share. So when they do that, all of a sudden more shares, it's cheaper, and more people want to buy it. And of course, if more people buy it, the value goes up again.
Okay. So if you had existing stock, it wouldn't really have a negative impact on you.
No, it wouldn't. But it will actually have a positive impact, because, I mean, technically it will have no impact because, so let's say, for example, you bought 1 share of this. Are you following me?
Yeah.
So you only had 1 share at the moment. If they did a stock split and split into 2, then you have 2 shares, but it will just be 2 shares of 1,500 each. If they split into 3, then you just have 3 at 1,000 each, but it's still the same value. You know what I mean? But you just have 3 shares. Yeah. But because they've split it and more people now decide to buy it, then that would cause the value to go up.
Yeah, okay.
And then you then benefit from that. So that's why, now this is the other thing I was going to say. If you go to long-term, where is it? Topics, where are we? Can you see my screen, Uzo?
Yeah.
Yeah, so if you go to topics, and I think it was under long-term investing. Let's see. So under long-term investing, let's see. Because when Apple did a stock split sometime last year, I also posted it on the platform, and I explained stock splits then in relation to what they did. I hope I find it. Talked about penny stocks there. Let's see. So actually, this is just for everyone else that, do take advantage of some of the previous posts, because some of the posts, more often than not, I use the posts as a teaching tool to highlight certain things. Let's see. There you go. So you can see this 7 months ago. Damn, that's a long time. Okay. So you can see this was posted Friday, 31st of July last year.
Okay.
So you can see this is where Apple did the same thing too. So Apple, then they announced the 4-for-1 stock split. In fact, there is much cheaper than Amazon. You can see Apple stock was trading at $380 per share. So it means investors should expect to have a chance to buy a share of Apple for around $100. So we're going to split it into 4. And I put there the reasons for stock split. So like I said, a split is usually undertaken when the stock price is quite high, making it pricey for new investors to acquire them. Then the new higher number of shares outstanding can result in greater liquidity for the stock, meaning more people want to buy it. And then increasing the liquidity of a stock makes trading the stock easier for buyers and sellers.
Okay.
So yeah, so that's why, and I'm happy you brought that up. So I could just highlight this to everyone again. It's just to go through. So yeah, if you go to, again, just for everyone, if you go to topics, so if you go under long-term investment and also general topics on the financial markets and these themes, I use that as an opportunity to highlight or give you more information regarding, so things like the stock split or other things that, which I can't remember. But they're there. So yes, so yeah, with Amazon being now $3,000, dollars, you wonder whether they might just say, this is getting too expensive, let's split it. But again, they might decide never to. A good example is Warren Buffett. His Berkshire Hathaway stock, which is the most expensive stock in the world, BRK. With Berkshire Hathaway, Warren Buffett says he would never split his stocks. So that's why is on it to buy one share of Berkshire Hathaway is $393,000 just to buy one share. So Amazon too might decided that they're not going to split it, but we'll see.
Okay, thank you.
Pleasure. Any other questions? Any other questions, comments, complaints? If you have issues with me, also time to complain. Okay, so if there are no questions, I'll just quickly, oh, Uzo, do you have a question?
No.
Oh, okay. So like I said at the beginning, it's just to keep an eye on the markets. Obviously if you're settled on your portfolio and you're not looking to buy for now, then that's fine. But if you're in the process of looking for what to buy, like I said, it's good to start to look at all these industries that might start to recover with the economies around the world opening with the mass vaccination, because I'm sure the airline industry will start to pick up, the restaurant industry, the hospitality industry, the tourism industry, all these industries that have been affected badly by the COVID crisis. As you know, this might be an opportunity to pick up very cheap stocks as they begin to recover and make a potential killing when they rebound, when economies are fully open. But like I said, number one, this is not a recommendation. And number two, make sure you do your homework and your fundamental analysis. Okay, so there are no more questions. Oh, you went. Do you have a question, Uzo? Anytime you're on mute, I think you have a question.
No, I'm muted so that when it's time to say bye, I can say bye.
Okay, you can say that now. Because I think since there are no more questions, I think it's time to say good night to everyone. So have a nice evening, everyone.
Thank you.
Pleasure. Enjoy your evening. Stay safe. And we'll catch up on the platform.